Silver is trading around $72.36 per ounce, up roughly $3.80 today, a move of about 5.5%. On the one-day chart, silver opened near $69, saw early volatility, and then moved sharply higher with strong buying into the session. Market observers are pointing to industrial demand, including solar, electric vehicles, and technology, along with safe haven interest and expectations around lower interest rates. So far in 2025, silver is up nearly 150%, making it one of the strongest performing metals this year. London OTC forward market stays firmly backwardated even after this huge rally. Top physical dealers are already reporting they're completely sold out of kilobars, and former head of JP Morgan Precious Metals desk says there's very different stories being told by gold versus silver right under the surface. Today, we're looking at what these signals actually mean and why they're not the same story. Short disclaimer. This video is for information and education purposes only. Nothing here should be understood as investment advice, trading recommendation, or solicitation to buy or sell any asset. Let's start with the big picture numbers that everyone sees first. As of mid-December 2025, silver futures have made new multi-year highs, spot price pushing into the high 60s and briefly touching $72. Gold, at the same time, is also making new all-time highs, currently sitting roughly in the 2850 to 2900 zone, depending on the hour. But when you go one layer deeper into the actual cost of borrowing and carrying these metals in the professional market, the picture starts to split very clearly between gold and silver. We'll begin with gold because it's the simpler, cleaner story right now. In the London OTC market, this is the big interbank institutional unallocated forward market. You can currently lend US dollars against physical gold for 1 month and receive somewhere around 9% annualized yield on your dollars. That is a roughly 5 to 5.5 percentage points above current SOFR, the secured overnight financing rate that basically represents the cost of money in the cleanest, shortest term secured lending market in the world. That is an enormous spread. In more normal times, you would expect gold lease rates, GOFO, to be very close to zero or even slightly negative. Right now, we're seeing levels that are reminiscent of very stressed year-end balance sheet periods, except it's not December 31st yet. The February CME Gold EFP, exchange for physical spread, is also sitting in the -30 to -35 cent range, which annualizes to roughly 6.8 to 7%, depending on exact calculation day. Again, very elevated compared to the cost of money. Robert Gottlieb, who ran the precious metals desk at JP Morgan for many years, described the current gold situation as looking more and more like a classic hot potato market. Banks are reluctant to hold the long gold position across year-end balance sheet reporting dates. They want to reduce balance sheet usage. Therefore, they're willing to pay very high rates to borrow gold short-term or to pay wide EFP spreads to give the gold away on an exchange for physical basis. That is the gold narrative in a nutshell. Very strong paper and institutional demand, year-end balance sheet friction, banks pushing rates wider in the OTC market. And so far, despite these very high implied lease rates, physical availability in the professional market has not been reported as critically tight. Now let's move to silver, and this is where the story becomes noticeably different. Silver 1-month forward points in London OTC are still quoted in substantial backwardation. That means the nearby forward price is lower than spot, sometimes significantly lower. When you see persistent backwardation in a forward curve, especially after a 50+% rally in the spot price, it is generally considered a very strong signal of physical tightness. The March silver EFP on COMEX, exchange for physical spread, has been very volatile. It spiked out to extremely wide negative levels on Friday, implying very high implied lease rates, then snapped back sharply on Monday, closing around -2 to +4 cents. But even after that retracement, the London OTC curve has not followed. The 1-month, 3-month, 6-month points are still showing meaningful backwardation, and in some cases the curve is backwardated all the way out to 12 months. That is not normal behavior after a parabolic price move. Normally, when price runs that hard, you expect the curve to flatten or go into contango as speculative long positions get financed and physical demand cools off a bit. Silver is not doing that. The professional market is still saying we would rather have the metal right now than later, even at these much higher price levels. Gottlieb's exact comment was roughly, different metals, different signals, same underlying stress in physical markets. He believes the silver OTC tightness, despite the huge rally, is telling a more fundamental structural story than the gold situation, which he sees as more driven by balance sheet window dressing and very strong institutional paper flows. Next piece, physical retail, dealer level. Multiple major retail dealers in North America and Europe have publicly stated in the last 48 hours that they are completely sold out of 1 kilo silver bars. Some have also run out of 100-ounce bars and even certain sizes of 10-ounce bars. Delivery times on newly ordered generic kilo bars from refiners are being quoted in multiple weeks, in some cases 6 to 10 weeks. This is not the same as saying the entire wholesale market is sold out. It isn't. But it is meaningful that the retail channel, which usually absorbs supply overflow during big rallies, is now flipping to supply-constrained mode while the price is still accelerating. On the demand side, industrial consumption continues to grow. The main drivers everyone talks about remain the same. Photovoltaic, solar, still the single largest industrial consumer. Electrical and electronic applications, especially high-end connectors, switches, and conductive pastes. Automotive, both EV powertrain components and traditional vehicle electronics. 5G infrastructure, AI data center cooling and power management, medical imaging and antibacterial applications, defense and aerospace. None of these categories are showing signs of meaningful slowdown. At the same time, primary mine production remains roughly flat to slightly down year over year. Secondary supply, recycling, has not ramped dramatically, and visible above-ground inventories in major exchanges and LBMA vaults have continued trending lower throughout 2025. Put those pieces together and you get the classic structural mismatch that commodity analysts have been warning about for years. Demand trending higher structurally, supply very inelastic, investment interests suddenly reaccelerating on top of already strong industrial base. When all three of those things happen at the same time, history shows that price resolution usually does not happen in a slow stair-step fashion. It tends to be sharp, violent, and catch a lot of people off guard, both on the upside and eventually on the correction. Last thing worth mentioning, the divergence itself. Gold is showing very high implied lease rates mostly because of financing, balance sheet pressure, plus very strong institutional and ETF buying interest. Silver is showing persistent backwardation in forwards even after that kind of price action, which historically has been a much more reliable indicator that physical availability is genuinely constrained, not just that people want to own the paper. These are two different kinds of bullishness running in parallel right now. They're not contradictory, they're just not the same driver. That's the current snapshot as we head toward year-end 2025. Just to be very clear one more time, this video is strictly for informational and educational purposes. We are not financial advisors. Nothing in this video is investment advice, trading advice, recommendation to buy, sell, hold, or do anything with any asset, including gold, silver, mining stocks, ETFs, futures, or any other instrument. Precious metals markets are extremely volatile and can move aggressively in both directions. Always do your own research and if needed, consult qualified financial professionals before making any decisions with real money. Past performance and current market signals are never a guarantee of future results. Thanks for watching. Take care and we'll see you in the next one.